What's up YouTube? I'm back again with another video, and today I'm going to be playing the 2020 full year results presented by Rolls-Royce. If you like these types of videos, please remember to hit like and subscribe. I appreciate all the feedback. You guys have been awesome. And without more to say, let's get right into it.
Welcome everyone to our 2020 full year results presentation. With me today are Warren East, CEO, and for his final results with us, Stephen Daintis, CFO. Also with us today is our Deputy CFO, Ben Fidler. We'll start the presentation shortly with an introduction from Warren, followed by a more detailed review of results by Stephen, and lastly returning to Warren for an update on our outlook and strategy. In all, this should take about 40 minutes, leaving plenty time at the end for Q&A. Before I hand over to Warren, please take note of the Safe Harbour statement on slide 2. This results presentation contains forward-looking statements that involve risk and uncertainty that may cause actual results or developments to differ materially. A full set of results materials can be downloaded from our website. Thank you, and over to you, Warren.
Good morning, everyone, and thank you for joining us. Now, before we look at our performance in detail, I'm going to reflect for a moment on the extraordinary and unprecedented year in 2020, and you can see from the images on the top of the slide there about just how devastating it was for our sector. It was also devastating for many people. It was a year where our colleagues made many personal sacrifices, and despite all the challenges, they still managed to dig deep to find the solutions to help keep our company strong for the future. And I'm very mindful of the fact that around 7,000 of our colleagues, some of whom have worked with Rolls-Royce for many years, have left us as we took actions to restructure and protect our business. And I thank all of those colleagues, both past and present, for their contributions, their diligence, and their hard work. Looking at the images on this slide, I'm particularly proud of the practical support that our people have given to the communities in which we work, doing things such as making face shields and volunteering to help those in need. As a company, we also endeavoured to give back to our community. We launched the Emergent Alliance, and that's now grown to more than 140 members, and we've worked together there as a community using data analytics to assist economic recovery. Here in the UK, we also joined the ventilator programme, and we've been providing home learning and STEM materials to encourage online learning for young engineers and inventors of the future. Finally, of course, I must thank our investors and our lenders who helped us and gave us additional liquidity to weather this crisis. So as we move forward, preparing for the recovery and investing for the future, we're very aware of the responsibility that we now have to honour the support we've received from all of our stakeholders by delivering on commitments that we've made and achieving those goals. So now moving on to group performance, I'm on slide 5. When COVID arrived early in 2020, it had an immediate and very material impact on our business. If you remember, we came into 2020 with great positive momentum, and that momentum that we had at the start of the year was overtaken. And in response, we took decisive and effective actions to protect our people and protect our business. We introduced new ways of working to protect our colleagues, and that has enabled us to maintain operations throughout with minimal disruption. We took mitigating actions that saved more than £1 billion in cash. We secured more than £7 billion of additional liquidity to secure the future, and we embarked on a very large restructuring, the largest restructuring in our history, to fundamentally change the economics of our civil aerospace business, and that's going to save more than £1.3 billion of annual costs on an ongoing basis. We've also committed to rebuild our balance sheet, which is supported by a disposal programme where we're targeting more than £2 billion from disposals by 2022. Despite the enormous pressure on cash and the cost reductions, however, we managed to continue to invest in sustainable, low-carbon solutions for the future, and I'm going to come back and say much more about that later in this presentation. But now looking at the business highlights for 2020, I mean, the impact of COVID on our business, you can see on the right-hand side of the chart, different businesses affected in different ways. The impact of COVID was most acutely felt in our civil aerospace business. with engine flying hours reducing sharply in April to less than 20% of 2019 levels. And as the year progressed, those flying hours gradually recovered. Now, while the rollout of vaccines and testing gives us good reason to look forward to the recovery, the impact on our industry is severe, and OE demand is expected to remain low for several years. On large engines, on wide-body aircraft, that's where we're most exposed to the downturn. International and business travel particularly was affected, and that's likely to recover slowly. Regional and narrow-body flights have been marginally less impacted, with fewer cross-border routes. Business aviation was relatively resilient, and that was helped initially by repatriation flights at the start of lockdowns, and of course, much less exposed customer base. Now, we've made good progress on our fundamental restructuring program in civil. Around 5,500 of the roles removed so far from our business are from the civil aerospace. And that will, of course, give us permanent cost efficiencies and help reshape the economics of our business for the longer term. And I'll talk more about that later in this presentation. Despite the challenges, we've managed to continue to serve our customers. We've managed to design and manufacture solutions and invest in new technology. We've achieved our target of eliminating aircraft on ground due to the Trent 1000 durability fixes. And we've now got enough parts and MRO capacity there on Trent 1000 to avoid a recurrence of any customer inconvenience, even if miraculously all travel restrictions were lifted today. In ITP Aero, we've seen, of course, similar market dynamics, because civil aviation accounts for about 70% of ITP revenues, and defence activities in ITP contributing the rest. That performed relatively resiliently. Power Systems was less affected than our civil aerospace, but still quite affected by what happened. But it has a number of end markets, each with its own dynamics, and that has helped to balance the business performance in Power Systems. Government end markets, for instance, were the most resilient, whereas industrial and marine suffered from the impact of lower economic activity and lockdown restrictions. Our strategy in Power Systems to grow in China also helped the overall performance of that business, with structural growth and market share gains continuing. And our solutions to support and enable the transition to lower carbon power have had a good year, driven by investments in batteries, hydrogen fuel cells, and hybrid systems. And moving to the bottom of the slide, defence. Defence had a good year because our government customers remained committed to the programmes that we're delivering, and our order book remained strong. And this year or 2020, has been a real reminder of why the defence business is an important one for our group, delivering profit growth even in what turned out to be the most challenging of years across the rest of our business. Now, I'll hand over to Stephen to talk more about our financial performance.
Thanks, Warren, and good morning, everybody. So, our full year 2020 results were severely impacted by COVID, as Warren has just outlined. In addition to the trading impact, there were a number of large one-time charges in our underlying and reported results. Now, they're shown here on this particular slide, slide 8. These charges were mostly incurred in the first half of the year, when the outlook suddenly deteriorated. Group revenues declined by more than 20%. This reflected the drop in activity in civil aerospace, ITP Aero and Power Systems, but also the impact of a £1.1 billion negative catch-up charge on our civil aerospace long-term service agreements. This related to changes in the outlook on our long-term contracts as a result of COVID, which led to the de-recognition of some of the revenue that has been booked in prior years. Now, we had a gross loss of £512 million in 2020. This included £1.3 billion of one-time charges, most notably the impact of the contract catch-ups that I've just talked about, although the gross profit charge was slightly lower than the revenue impact after taking risk and revenue share partners into account. In addition, we took a £230 million charge related to onerous or loss-making contracts. Now, we don't have many of these, and they are mostly related to the Trent 900 engines on Airbus A380s. As the largest passenger plane in service, these have been particularly affected by the fall in passenger demand. It's been a very tough year for everyone in our industry. A number of our customers have had challenges with their liquidity and financial stability. We have responded commercially with relaxations of certain terms and conditions, and we're keeping a close watch on the customer credit risk. Prudence requires that in some cases we provide for specific customer credit risk, which is why we have taken an £86 million charge in this respect. The final large charge on our underlying results is the £1.7 billion financing cost charge related to our hedge book. Our US dollar hedge book provides cover for transactional currency risk because our dollar receipts usually exceed our dollar costs. The impact of COVID on our future forecasts left us significantly overhedged, and so in 2020 and early 2021 we reduced the hedge book at a cost of £1.7 billion spread over the next 6 years. Now you can see on this slide the business unit performance in more detail. As Warren has already talked about the market drivers of our performance, so I won't need to cover those again. What you can see here is the scale of the impact of the drop in performance in civil aerospace has had on the group, as well as the impact of the COVID-related one-time charges, which make up most of the loss. Power Systems, Defence and ITP Aero all contributed positively to operating performance, albeit only Defence achieved year-on-year growth up 8% on 2019. Now this next slide details the successful mitigating actions we took this year to help protect our financial and liquidity position. We've had a laser-like focus on cash costs, culminating in year savings of more than £1 billion compared to our plan at the start of the year. The largest savings of around £500 million came from a reduction in pay and benefits. Now this was a result of three key things. Number one, a pay cut for senior managers during the 9 months between April and December. Secondly, support from government furlough schemes. And thirdly, savings starting to come through from the reduction in roles in the second half of the year. Furthermore, we reduced our capital expenditure by around £300 million. We stopped all non-essential spend and rephased some of our projects. About 2/3 of our savings were in civil aerospace, where earlier plans to increase capacity were shelved, as we now expect to meet the forecast load within our existing facilities. We've reduced the pace of investment in spare engines, and we've also challenged capital plans across the group. Engineering spend was also reduced, as industry-wide delays have allowed us to slow down our R&D spend without jeopardising our commercial objectives. We've also saved on third-party costs and travel, and absorbed the additional investment needed to make our workspaces COVID secure. Now, most of our mitigations were one-time or temporary, however. Some of the savings are expected to roll into our fundamental restructuring programme, helping to deliver the £1.3 billion of annualised savings by the end of 2022. Achieving more than £1 billion of savings so swiftly is testament to the collaboration, dedication and focus from everyone in the business. Not only have personal sacrifices been made, but we have pulled together to find savings, no matter how small, to contribute to the group-wide effort to protect our business. I'd like to thank everyone at Rolls-Royce for the part that they have played delivering this extraordinary response to the COVID crisis. Now on this next slide, we had a £4.2 billion group free cash outflow in 2020 compared to a £900 million inflow in 2019. This £5.1 billion year-on-year movement can be divided into three broad categories. Firstly, compared to 2019, there was a £3 billion impact from operational factors. Now, this is mostly due to the lower engine flying hour receipts from the long-term service agreements, but also includes lower time and material receipts and the impact of under-recovery of fixed costs, particularly on civil OE original equipment volumes. Although Power Systems and ITP Aero contributed positively to group cash, they were down year on year, which was only partly offset by growth in defence. Secondly, we had a £2.1 billion swing in working capital, moving from a £0.4 billion inflow in 2019 to a £1.7 billion outflow in 2020. Now, this was mostly due to our decision to stop invoice factoring, which resulted in a £1.1 billion adverse one-off timing impact to cash. The rest was a reflection of the underlying reduction in working capital as our activity levels diminished significantly in 2020. This compared to the previous trend of cash inflow from working capital as we grew the business. Now finally, there were a range of other smaller factors moving in both directions which largely net each other out. Included within these are the costs of closing out the hedges in 2020, as well as the positive swing of around £400 million from the lower capital spending due to our cash mitigations. This next slide shows how these three movements show up in our summary funds flow in more detail. The Civil Aerospace net LTSA balance grew by £479 million in 2020, which may feel a little counterintuitive given the significant fall in flying hours. Now this is the result, though, of the £1.1 billion contract catch-up to revenues that I outlined a little while ago. Typically, we expect to see an increase in the LTSA balance as we grow the fleet. However, this year, if we adjusted out the catch-up effect, we had a reduction in the LTSA balance as revenues, which as you know are driven by shop visits, were larger than the flying hour receipts. The £138 million movement in provisions is the net result of new provisions for onerous contracts, offset by the reduction in provisions related to the Trent 1000 in-service costs. You can also see here the £202 million cash impact of closing out unutilised hedges. Although the cash headwinds from the hedge book and Trent 1000 fixes are substantial and multi-year, they are not permanent elements of our cash flow. In 2020, the cash impact of these combined was around £700 million. Moving on to 21 and 22, they are expected to be around £800 million and £500 million respectively. But beyond 2023, importantly, the headwind from Trent 1000 is expected to be de minimis. The last of the hedge costs will be in 2026. Now, further details of these are included in the appendix slides. Moving on to the next slide. We strengthened our liquidity in 2020 to cope with the uncertain outlook and near-term cash impact of the COVID crisis. At the start of 2020, we had £6.9 billion of liquidity and a net funds position of £1.4 billion. Our £3.1 billion of debt included €750 million of bonds maturing in 2020 and $500 million maturing in 2021. Now, we had expected to cover these maturities with the cash generated by the business. With the arrival of COVID, we took the precaution of drawing down on our £2.5 billion revolving credit facility, which had a duration out to 2024. As the extent of the pandemic became apparent, we took the necessary actions to ensure that we would have enough liquidity and a sufficiently long maturity profile to manage even in a severe but plausible downside scenario. We agreed new loan facilities, £1 billion with a 2-year term and £2 billion with a 5-year term, and we lengthened the £2.5 billion revolving credit facility to 2025. We were supported by the UK Credit Export Agency with an 80% guarantee on the 5-year term loan. In the fourth quarter, we added to this with a £2 billion bond issue and a £2 billion rights issue, which were both well supported by our investors. This leaves us all in a strong liquidity position, with around £9 billion at the start of 2021, and most of our debt does not mature until at least 2025. This gives us the strength to weather the near-term cash outflows, and we expect to return to generating cash from operations in 2022. Today we have £5.5 billion of undrawn facilities, and additionally we have just agreed a £1 billion extension to the 5-year term loan with the UK Export Finance and our syndicate of banks. We do not expect to draw on this extension even in a downside scenario, but it provides an important safety net. Moving on to the next slide. Our strong liquidity will therefore see us through this crisis, but afterwards we will need to rebuild our balance sheet. We do not intend to remain in a net debt position. We're in a cyclical industry and need a strong balance sheet to be able to weather the storms without jeopardizing our commercial position or our through-cycle investments. The first step on the road to financial recovery came from the support of our shareholders, with the £2 billion proceeds from the rights issue in 2020. We expect to at least match this with proceeds from disposals, which I'll say more about in a moment. The remainder of the bridge comes from cash generated organically from operations, the actions we are taking to restructure the business, and the expected recovery in engine flying hours should enable us to get back to a healthy cash generation by 2022. This underpins our ambition to reach a net cash position in the medium term, consistent with an investment-grade credit rating. Now on this next slide, and before I hand back to Warren, I promised to say a bit more on our plans for asset sales. We've got off to a good start, with 2 disposals already agreed and due to complete later this year. Firstly, we agreed the sale of our civil nuclear instrumentation and control business to Framatome. Secondly, we agreed to sell Bergen Engines to TMH International. Now this transaction has been temporarily paused at the request of the Norwegian government to be further reviewed by them. It is not for us to speculate on the outcome of the government's review. However, it should be noted that the sale of Bergen is only one part of our disposal programme. Although both of these are good businesses, neither of them were central to our future strategy, and they did not generate any material profit or cash flows. Between them, they generated about £300 million in annual revenues. The largest of our planned asset sales is ITP Aero. We've started the disposal process with the proposed transfer of our Hucknall facility and some of the work from Barnoldswick into ITP. We're holding talks with a number of interested buyers. No one has been ruled out, and we're working closely with all the key stakeholders to find the right path forward. We've got a number of other assets under consideration too, not just in civil aerospace, but across the group. We're not in a position to name these yet, as they are at a relatively still in their early stages, but we expect to see further progress by the end of 2021 on all processes. I'll now pass back to Warren to discuss our outlook and our strategy.
Thank you, Stephen. Okay, let's move on. Now, as I said before, this has been an unprecedented time. We have faced up to the challenges with decisive and effective actions to take control of the things we can control and manage the things that we can't control. And within that framework, we have 3 clear priorities as we look forward. First of all, restoring our financial performance, then thinking about how we maximise value from our existing capabilities for the medium term, and looking further forward, how we deliver the science-led innovation in sustainable power that's going to take us forward into the longer term. And I'm going to take each one of these in turn. So let's start with our financial performance and how that changes. We'll step back for a moment and look at the global economy. The impact of COVID on the global economy has been greater than any other event in recent history. You can see it from the chart on the top right here. Nonetheless, there is cause to be optimistic about a V-shaped recovery. And that's underpinned by the efficacy of vaccines and the decline of infections in locations where vaccinations and testing have been rolled out. Initial data is very encouraging. The pace and timing for opening up borders, however, remains uncertain today, but it's clear from our airline customers that there is significant pent-up demand from consumers for flights just as soon as they're able to resume. And this could be accelerated by vaccine passports, air bridges, or other risk-based approaches between countries with low levels of infection. Now, in civil aerospace, there is, as you know, a historic correlation between GDP and flying, with growth in passenger miles increasing at around 1.5 times the pace of economic growth. And there's also a strong link between the development of a country's economy and the penetration of flights per person. And as a result, fast-growing economies with low levels of air travel fuel the long-term expected growth trends for our industry in the coming decades. And this makes it hugely important that we develop the right low-carbon solutions that will support these economies to develop cleanly and sustainably. And I'm going to elaborate more on that in future. Now, Power Systems is also a GDP plus business. But unlike aerospace, it doesn't have particular issues around opening up of travel corridors and government-to-government agreements. And so we expect the V-shaped recovery in GDP to result in a faster recovery of revenues and profits. Defence, as I said earlier, has been less impacted by the crisis. It's also less impacted on an ongoing basis by fluctuations in GDP, because government allocations are driven more by the need for investment based on geopolitical risk. And actually, we don't see that geopolitical risk changing anytime in the near future. But of course, there will be pressure, or likely to be pressure at any rate, on total government budgets in coming years as they seek to repair the economic and social damage that has been caused by COVID. So, moving on to slide 19, talking about defence and power systems. I'll start there with a little more detail. Power systems and defence have been the bedrock of support for us this year, and they've contributed over half our revenues and generated both profit and cash for the group. Power systems provides the power for industrial and agricultural growth, as well as travel and infrastructure. And reliable power is critical for continuity of services, and our microgrids and backup power solutions can provide that. And as we see economies reopen and get back to business, so we expect our customers' capital expenditure cycle to accelerate, and that will drive a sharp recovery in demand for our OE and for aftermarket services. And so we see our power systems business returning to 2019 revenue levels by 2022, along with a margin recovery back to double-digit levels. And that is helped by structural growth in China, as I've mentioned before, and increased pace of development of low-carbon solutions, as well as the general recovery from COVID. In defence, we have a stable outlook, we have a strong order book, we're working continuously in that business to offset inflation and pricing pressure with savings and operational efficiencies. And we think that we're in a good position to benefit from future programme opportunities as they emerge. So now let's look at civil aerospace on slide 20. Clearly, the pace and timing of recovery in engine flying hours remains uncertain, but the progress on vaccines and testing is encouraging. At the start of the year, in January, we updated our expectations for 2021 to reflect the challenges that the world is seeing from new virus variants and new national lockdowns. And our view of a recovery in 2021, we modified, and this is particularly about the Rolls-Royce fleet, by the way, but we modified to an average of around 55% of 2019 levels. And that remains unchanged as we sit here today. Today, activity is actually below that level, but based on third-party projections and conversations with our airline customers, we expect the recovery to pick up in the second half of the year, flights fill up and airlines open more routes. And this recovery is likely, of course, to be led by short-haul leisure demand, and that will be followed by business trips and long-haul journeys. Now, turning to our expectations for engine flying hours in 2022, we're now expecting around 80% average flying hours in 2022 compared to 2019, and that's different from the 90% we talked about previously. The impact of this downward revision on our £750 million cash target has been mitigated by additional management actions and our latest view on certain cash movements. We've also refreshed our plausible and severe downside scenario to make sure we're well prepared should the recovery take a little longer. Full details of our scenarios are included in the press release, but in summary, we see a reasonable worst case of around 45% of 2019 levels in 2021. That's flat on 2020, but it's a bit higher than the levels we're seeing today, and approximately 70% of 2019 in 2022. So we continue to see a disparity between the different engine programs, the chart on the top right-hand side of the slide. And you can see that shows that the newer, more efficient aircraft and engines are the ones that are recovering faster than the more mature ones. And that's, of course, driven by the economics for airlines as they look to minimize their operating costs And it's also driven as well by the geographic mix and customer concentrations of our fleet. You can see our Trent XWB engines have been the fastest to recover. They've already reached around 60% of prior year flying hours by the end of 2020. And that's followed closely by the fleet of Trent 1000s. One of the bright spots for the whole industry last year was the winning combination of our Trent XWB engine on the Airbus A350. This is the most fuel-efficient wide-body aircraft in the world, and it has versatility to serve both long-haul and short-haul routes. We're already exclusive on the A350-1000 variant of the aircraft, and we are extending our position, our exclusive position on the A350-900 variant, and that accounts for the bulk of the A350 fleet, and that extension is agreed with Airbus out to 2030. That's in line with the development timeline for our next generation UltraFan engine program. And just to remind you, by the way, that we're also the exclusive engine provider for the A330neo with the Trent 7000. So, slide 21. I talked so far about recovery factors that we can't control, engine flying hours, behaviour of airlines and the like. Now I'm going to talk about things that we can control. We were quick to recognise the need for self-help actions to control our cost base and position our business for the future last year. And in May we announced a fundamental restructuring programme, the largest we've ever undertaken. The impact on our people of a change programme of this scale cannot be underestimated, and we certainly did not take this decision lightly. We're consulting with colleagues on the proposed actions. We're working with unions and employee representatives to try to limit the number of compulsory redundancies and protect as many livelihoods as we can. We've increased support for mental health and well-being, and we're helping those that are affected by redundancy to find alternative roles, sometimes elsewhere in Rolls-Royce, sometimes outside of the company. But the outcome we're targeting is clear. We need to restructure our cost base and eliminate the under-recoveries and set up the framework that will enable us to recover strongly when activity levels return. So we've set a target to achieve annualised pre-tax savings of more than £1.3 billion by the end of 2022. Now, our plan for this includes the removal of more than 9,000 roles, and most of those are in our civil aerospace business. It includes consolidation of our operational footprint and cost discipline right across the business. And we're also looking to keep our capital expenditure low, and we're aiming to be at the better end of our peer group range of 3 to 4% of revenues in that respect. Now, we made a strong start in 2020. In 2020, around 7,000 roles were removed across the business, mostly through our voluntary severance programs, but also as a result of hiring freezes, fewer contractors, some compulsory redundancies. We also began consultations to consolidate the major civil aerospace operating sites, consolidating 11 sites down to 5, with activities being moved to the most productive, cost-effective hubs, and a reduction in the duplication of work in multiple locations. We're engaging with all the stakeholders to make sure that our actions are both fair and effective. Let's have a look at the economics. The changes are fundamentally altering the economics of our civil aerospace business, and that's shown here on slide 22. The majority of our cost savings are targeting fixed costs in our civil aerospace business. We're reducing headcount by approximately a third, and we're looking to lock in substantial savings from those site consolidations and efficiency improvements. And on top of that, most of the planned group capital expenditure savings are also in civil aerospace, and there we have a reduction of more than 50% versus the 2019 levels. And that's, of course, helped by the growing maturity of our newest engine program, so some of that capex was going to reduce anyway. At the same time, we're seeing our variable costs reduce with load, but we're also pushing those variable costs even further. We're challenging ourselves to achieve better pricing and engineer greater efficiency to reduce per unit costs and wastes. It really is a fundamental transformation of the civil aerospace cost base. It's a program of self-help, and that will enable us to create a stronger business with more sustainable cash generation and a permanently lower fixed cost base, regardless of whatever the pace of recovery happens to be. And as the next slide shows, it sets us up well to benefit from huge operating leverage as the market recovers. So let's look and see what that means for our future cash flows. On slide 23, we can't control the pace and timing of recovery, which in turn is the main driver of recovery in both the aftermarket and the OE receipts part of our business. So those are the blocks above the axis. But what we can control are the blocks below the axis, which I've just talked about on the previous slide, but here you can see spread out in time. We can influence the rate of cash burn during the downturn and also, consequently, the operational leverage that we enjoy as the flying hours improve. In 2020, large engine flying hours were 43% of 2019 levels, and we delivered around half as many of new large engines. Business jets and regional did show more resilience, but still, the fall in receipts was quite significant. And you can see our response in the reduction of the turquoise bars below the line, representing the operating cost and capital spend. And that begins in 2020 with the cash mitigation that I talked about, but it continues in 2021 and 2022 as the restructuring program makes those savings permanent and expands them even further. However, due to supplier lead times and working capital movements, in 2020 it simply wasn't possible to reduce our total costs at the same pace that we saw in the fall in receipts. And that's what drove the civil aerospace trading cash outflow of £4.6 billion. In 2021, this does begin to improve because the purchasing reduces with lower volumes, and as we're able to turn off those taps, we still have a working capital headwind to contend with, and that is driven primarily by the OE concession payments that we talked about shortly before Christmas, as a backlog of 787 aircraft are delivered by Boeing, and that triggers payments from us to airlines. The timing of this is completely outside of our control, and while we expect significant concession outflow in the first half of 2021, it may slip a little bit to the right. Nevertheless, you can see that cash flow as a whole begins to improve in 2021. Once the market recovers more fully, you can see civil aerospace returning to positive cash flow. And assuming flying hours reach approximately 80% of 2019 levels on average in 2022, we will see the civil aerospace business delivering cash flows that support our group ambition of at least £750 million of free cash flow. Looking longer term, the actions that we've taken to change our cost base and position for the recovery mean we're confident we'll be able to keep those costs low as volumes increase, and that will deliver better cash margins in future than we have achieved in the past. So that brings me back now to the group outlook for the near term on slide 24. We're expecting free cash outflow of around about £2 billion in 2021. The first half will see the worst of the outflows, mostly due to the shape of expected flying hour recovery and the timing of those concession payments. In the second half, there should be benefit as vaccine and testing allows more routes to reopen and working capital pressures begins to ease on those concession payments. Both halves are expected to see cash outflow overall, but at some point during the second half of the year, we expect net cash outflow to become net cash inflow, marking the inflection point in our recovery. Now, as we move into 2022, we expect those improvements to continue and drive sustainable positive cash inflow, and that could total as much as £750 million in the year as a whole in 2022. That's not adjusted for any disposals that may have completed by then, but it does remain contingent on the recovery in flying hours to at least about 80% of 2019 levels. Now, despite the uncertainties of the exact timing of that, we're confident that over a 12-month period starting at some point in 2022, we're going to achieve that target. Looking further ahead, our ambition to get back to at least £750 million as early as 2022 includes up to £500 million of temporary headwinds from the Trent 1000 fixes and the closure of our overhedged positions. So our projected future cash flows will benefit as these diminish in the years going forward. So slide 25. Now that that's effectively covered how we are restoring our financial performance, I'm going to move on to how we're positioning ourselves for the recovery and creating a sustainable future. And that's two things. First, by maximising the value from our existing capabilities in civil, in power systems and defence. And secondly, through the science-led innovation in sustainable power that we talk about quite a bit. And that includes exploring opportunities with things like sustainable aviation fuels, exploring opportunities around hydrogen, and I'll come on to talk about that in a moment. So on slide 26, maximising the value from our existing capabilities, it's all about what we can do in each of our business units to really capitalise on our position. We've invested heavily in civil aerospace over recent years, but that major investment cycle is now largely complete, and our fleets are amongst the youngest in their respective markets. So the focus now is on extracting aftermarket value from that installed base, with more than 5,000 large engines and 7,000 business jet engines. And we can do that by improving time on wing and continuing to reduce the costs of components. Similarly, in power systems, we've got an installed base, more than 150,000 large engines, which gives us a great foundation to build upon. We're also exploring how we can really grow our strategic position in China, which is a fast-growing market for power systems, as well as commercialise our electrical, hybrid and hydrogen solutions. In defence, there are two particularly notable engine programs, and we're awaiting decisions on those in the next 2 years or so. These are the B-52 re-engine program and the Future Vertical Lift program, and together they have an estimated lifetime value of more than £7 billion. And we're also continuing to work on through-life upgrades to engines in service. Slide 27 shows what this means for our capital allocation. On the left-hand side of the slide, you can see how we're pivoting our mid-term investments away from civil towards power systems and defence, because, as mentioned, the major investment cycle in civil is now largely complete. And in 2019 and 2020, we spent more than 70% on civil aerospace and ITP Aero. But looking into the medium term, we're going to see that decline, and it will be more like 50%. If we look at the chart on the right, we can look at that capital allocation through a different lens. This is the lens where we are accelerating our focus on low carbon technologies through self-funded and disciplined R&D. And as we move towards the midterm, the proportion of our investments in low carbon and next generation engines will really be the lion's share. The current investment in current technology falls from around 2/3 in 2019 to around a quarter in several years' time. And that rapid shift in investment spend reflects our net zero ambitions. If we're to become a carbon neutral business by 2050, and that means enabling the markets that we serve to be net zero by 2050, then it's vitally important that we take the steps now that will enable us to create more sustainable power in the future. Slide 28, I'm going to take each of these in turn and start with low carbon. Firstly, UltraFan, our next generation aero engine. As many of you will know, this new engine architecture is forming an exciting part of our sustainability journey. For starters, it's 25% more fuel efficient than the first generation of Trent family engines. It's also 100% SAF compatible, sustainable aviation fuel compatible. Now that efficiency is very important, as SAF will inevitably be more expensive than fossil fuel to begin with. Now, I mentioned SAF's a moment ago. And there's a lot of interest in this area recently, so just touching on that for a moment. For journeys over 1,000 nautical miles, alternatives like electric solutions and hydrogen solutions become very challenging or even impossible. So for Rolls-Royce, we see the use of SAFs, or sustainable aviation fuel, as being vital. And they require little change to our existing engine architecture. And what we're working on with partners in the industry are SAFs that can be simply dropped into the engine. They also have higher energy density and fewer impurities. And additionally, they can be created synthetically using captured carbon, using a zero carbon energy source, and that's what gives us our net zero. You may have read the announcements we've made recently about successful tests on our wide-body business jet engines. We've also been testing SAFs in our defence engines, and all the results have been extremely promising. However, it's not just aviation that can benefit from more sustainable fuels. Our power systems business also has a separate unit called Power Lab, and that's dedicated to our sustainable future. And there we're exploring the use of synthetic fuels in our power systems portfolio. Our hybrid electric solutions reduce further our CO2 impact, and we're embracing hybrid solutions in many different areas across the group. You've seen pictures of hybrid trains before from Power Systems. In Power Systems here, on the bottom of the slide, we have a picture of a hybrid electric engine based on the Series 2000 engine. That's ideally suited for yachts and provides increased power and lower noise pollution. Now let's turn to slide 29 and talk about enabling net zero. Now remember, an ultrafan engine running 100% synthetic aviation fuel generated from net zero electricity is indeed net zero, but we're doing more. As with SAFs, there's been a lot of interest and excitement in the aviation sector around the use of hydrogen. And just like others in the industry, of course, we're exploring the fundamentals of hydrogen in aviation. It's a very exciting area, and one that really pushes the boundaries and uses our existing engine technology. Our existing engine technologies could be adapted relatively easily to utilize hydrogen. There are large challenges for the industry that are industry more broadly, however, to overcome. But it's exciting to see the effort building around hydrogen. I'm confident that we have the technical capability to support our aviation customers if that is indeed the direction in which the industry moves. Aside from the use of hydrogen in aviation, there are also many opportunities for hydrogen in our power systems business. We're cooperating, for instance, with Daimler Truck on stationary hydrogen-powered fuel cell generators, and that would act as a CO2 neutral emergency power generator for critical facilities like data centers. And we're also working on ways to make energy storage more carbon neutral. We recently made a majority stake in the acquisition of Qnos, which is central to our microgrid solutions, enabling renewable power and energy storage. I would also like to talk about SMRs, or small modular reactors. You've heard us talk about that before. Rolls-Royce has unique expertise in high-density nuclear technology from decades of experience in defence. SMRs are small nuclear power stations which are factory-built, which have the ability to deliver electricity in a net zero way. In turn, this electricity could further contribute towards our net zero ambition, as of course it could be used to power the synthetic production of SAFs, or indeed of hydrogen. And we have UK government support for SMRs, and we're targeting the first power by 2030. They have much lower capex requirements, much smaller footprint per gigawatt. Now turning to slide 30, I'm going to come back to aviation and the progress we're making in electric aviation. It's particularly important for small and medium distance journeys, and it's an area where we're seeing a huge amount of interest and growth. Now, you may have noticed on Tuesday that we announced our first commercial deal in the urban air mobility market. It's a very significant step towards commercializing our technology. The deal with Vertical Aerospace uses a Rolls-Royce electrical power system which will be integrated into the piloted eVTOL vehicle. It's also particularly exciting as it has the potential to transform the way that people and freight move from city to city. In the commuter and regional space, we've got a partnership with Italian airframer Tecnam to jointly develop the P-Volt. That's an 11-seater aircraft in an all-electric battery and fuel cell configuration. And today, I'm announcing that we are expanding the successful research program between Rolls-Royce and Widerøe to cover all elements of developing and delivering the zero ambitions P-Volt commuter aircraft that could be used in the Norwegian market from 2026. And in the small propeller space, you might have read our announcement earlier this month that the Spirit of Innovation aircraft, part of the Accel program, achieved another major milestone. It's on track to be the world's fastest electric aeroplane. It successfully did its taxiing trial, propelled by its 50 horsepower or 400 kilowatt electric powertrain, and we are hoping to see the first flight of that aircraft in the spring. So let me summarise before we end our presentation today. Just a reminder of what we've been talking about. The decisive and effective actions we've taken to address the challenging market conditions we faced in 2020. We made in-year cash savings of more than £1 billion from one-off mitigating actions with the support of our stakeholders. We've strengthened our liquidity position to increase the resilience and support our long-term strategy. We've also made strong progress on our fundamental restructuring program, and we've commenced our disposals program to raise over £2 billion in proceeds. If we look forward, ahead to the recovery, then we're confident that those restructuring actions that we've taken in 2020 will enable us to have permanent cost efficiencies. We remain committed to supporting the decarbonisation of our end markets by pivoting our R&D and CapEx towards lower carbon solutions. And I'm confident we'll be able to offer, continue to offer growing low carbon technology for a more sustainable future. Before I hand back to the operator now for Q&A, as I mentioned, or in fact as Isabel mentioned at the start of this call, this is Stephen's final full year results with us. And I'd obviously like to thank Stephen for all his hard work and support, particularly during the recapitalisation efforts of the last year. I want to thank him for his friendship over the last 4 years as well, and help with putting this business back where it belongs. So thank you, Stephen. I think Ocado is very lucky to have you. And now, as the rest of you know, Ben Fiddler, who's here with us today, is stepping up to the role of interim CFO for a few months until our new CFO, Panos Kakoulis, joins us in May. And with that, I'd like to thank you all for listening and hand over to the moderator for Q&A.